3, 2, 1. Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're answering a listener question who is looking at alternative strategies. This is Serena who's messaged in, so thanks, Serena. And she said, look, I'm interested in learning other strategies for investing other than the BRRRR method, which is the buy, renovate, refinance, repeat that we talked about a few episodes ago. She says, what's an alternative for that? She says she's a high income earner with some good serviceability. She doesn't want 20 plus properties. She's got 3 already, and she says it's a headache around tax time. So what are some other strategies? I don't want a massive portfolio, but would it be a valid strategy to concentrate on high capital gains areas, even if it's slightly negative cash flow? And you might think, Ed, did you guys just message this to yourselves, given that this is the strategy, this is the ideal sort of person that our strategy that we usually use at OPAs would work for? And answer is no. Serena actually sent it in. But I do think that we have been guilty sometimes during this show, and in terms of not talking about the main strategy we actually do follow at OPAs, because we don't want to come across like we're trying to ram it down anybody's throat in this case. So I just thought, Andrew, let's open this up since Serena's asking about it. What is that kind of other alternative to the BRRRR if you do have some good income, some good serviceability, bit of equity within these 3 properties in Serena's case? What's the alternative?
Yeah, so yeah, it's right. Serena is the picture perfect client for OPAS partners, and that's because we focus on a very hands-off, low stress model. So we do focus on newer quality properties that are maybe a little more expensive than buying an older property, but tend to have lower vacancy, lower maintenance, and be focused in higher capital growth areas. And Serena's hit the nail on the head. Often, you might be slightly negative cash flow on those type of products. You are paying something for the privilege of not having any stress. You're paying for that insurance policy of lower vacancy, lower maintenance, and normally that's in a slightly negative cash flow. That's assuming that you're not using your cash, you're borrowing 100%. We're in an awesome part of the market right now where you can buy something in Auckland and it be cash flow positive from day one or neutral, which we're seeing all the time. We're helping clients get into the Auckland market with no money down and no cash on a weekly basis, which is amazing because it's the super city when it comes to capital growth because of those low interest rates and the fact that there's a bit of upward pressure on rents right now. So, Serena, what we tend to follow on is to acquire as many of those higher capital growth properties as one might need. And interestingly enough, that number's not as high as what you might think. So I remember when I started out investing, I'd go to seminars and the number was always 10. Buy 10 rental properties and you'll be set. Now, is that 10 $200,000 properties or $1 million properties? There's no real answer around that. So what we do is we actually look at what you actually need, and we trial out different areas based on what your cash flow will afford. So say, for example, someone came to me and said, hey, I've got $200 a week that I can afford to put towards rental properties. I might say, okay, well, let's buy something in Auckland that might cost, let's say, $100 a week when interest rates were a little bit higher. And then you might look at something in Hamilton, which might cost $50 a week. And then you might look at something in Christchurch that might cost $50 a week. And those 3 properties, the capital growth based on, say, 6% in Auckland and 4 or 5% elsewhere, might get you to where you need to be financially. And then you might couple that with a low maintenance, high yielding property like a dual key apartment or a room by room rental, something that's not going to go up very much in value comparatively, but will give you a superior cash flow so that your portfolio as a whole can be neutral. And so you don't need to worry about where that $200 a week is coming from later on down the track, particularly if you're going to enter retirement in the time that you're wanting that growth. But very hands-off, low stress is our model.
And just to talk exactly about what is that strategy, the strategy is to buy perhaps 3 to 5 properties, 6 properties maybe, but a small enough number that you're not stretched either in terms of worry and stress or that kind of emotional strain or financial strain as well. So building a decent sized portfolio, remembering that 5 or 6 properties is actually, you'll be one of the biggest property investors in New Zealand. You'll be certainly in the top kind of 5% of investors if you do get to 6 or above properties, and focusing on new. Now, why are new properties negatively geared, or why do they tend to be lower yielding? It's because you are capitalizing all of the maintenance costs because you're buying everything new. And so you're foregoing other maintenance costs further into the future where they would otherwise be higher. And so you're having that lower stress because you're paying for everything to be new upfront, so you have lower stress ongoing. That's why you do see a difference within the yield of these sorts of properties. That's why they tend to not be as high yielding, but that in essence has a benefit within there. Now, the other option as well, if you still wanted to be a relatively passive investor, but didn't want to focus on you, is you could do what Tim, one of our property partners, recently did, and we'll get him on the show to actually talk about this, which is where he bought a series of units and then paid professionals, so builders and tradespeople, in order to renovate those and still do the BRRRR method, but without actually being involved himself. Now, I was having dinner with Izzy, his wife, and him, and she was saying to me, look, I don't think for the stress that's involved, anybody should renovate themselves. She said, if you don't have the money to pay professionals to be able to do this, then you shouldn't be doing it. And she identified that actually, if you do use professionals or tradespeople in order to renovate properties for yourself, then that actually has the benefit of lower interest costs, because if you renovate a property yourself, it's going to take longer for you to turn that around and then it get back onto the market. Now, over that time, you're still incurring interest costs from the bank because you've taken out a mortgage in order to be able to settle and purchase that property. But if you get professionals in, then, and it only takes 2 weeks as opposed to 2 months in order to be able to turn that property around and get it rented, then you're going to save on interest costs. So it can be a little bit horses for courses here.
I also say that that's true when it comes to an accountant or a property manager. If you can't afford to buy a property with an accountant or a property manager in your budget, don't do it. If you can't afford to use a property manager in your budget, just defer until you can, or find something that will allow you to pay that, because at some stage it might become a headache. And as this particular question says, I have 3 properties at headache around tax time. We need some tax advice there, because I know that I have very little to do with my tax return filing. My professionals do that for me. So I wonder whether or not Serena's doing a lot of that grunt work herself. If she is, we would want a solution there where it's hands off, because the interesting thing here is I suspect she's been able to grow her portfolio more, but the fact that she sees it as a headache means that she's exhausting mental bandwidth. And I remember that this was where I was getting held back by my own ability to grow my portfolio. I could do it, but I didn't want the hassle of it. And so that is actually why the Opus system exists, because Andrew Nicol went through all of the possible scenarios of property investing and used all the different methods, and went, actually, these ones are quite a lot of hassle, and these ones, whilst they might cost me a bit more in the outset, it allows me to grow my portfolio because it's no longer an issue for me. I have so little to do with my portfolio that buying another property I don't even give a second thought to. Whereas previously, when I was a bit more hands-on, it was a hassle.
And that just compares, if I can think about the other episode that we did about Juno Investing Magazine, one quote that I left out from Tom Alexander, who was from the Hawke's Bay, had 33 properties, who manages all of them himself, is he says, it's not just full-time, it's very full-time. He says with a laugh, you love the New Year's Eve call-out where the tenants are locked out of the house. And he followed the BRRRR method. And again, that's the alternative, is to do the buy new, use professionals in order to be able to manage those properties without the stress, keep it I don't want to say small, because a portfolio of 5, 6, 7 properties is not small by national standards, but by compared to some of the other case studies you sometimes read of very, very successful property investors who have 122 properties, it seems relatively small. So that's the alternative to the BRRRR method, that buy new, keep it relatively small, use lots of professionals in order to be able to leverage their time, and then don't worry about it afterwards.
Yeah. So today is somewhat of a shameless plug, but that's because we were genuinely asked by Serena, and thanks for the question, Serena, because I think we probably have been a little remiss not actually making it completely clear what our model is, and it is the easiest way to become a successful property investor in New Zealand.
Hey, please don't forget to rate, review and subscribe. It really does help us get the message out to more people. And if you want to learn more about property with Andrew and I, then our monthly webinars are back for this month. It's happening on the 30th of June, so that's next Tuesday at 7 p.m. You can find a link to that in the show notes, or you can just go to opuspartners.co.nz/webinar, and we are going to be talking about, will property prices really double in the next 10 to 15 years? What are the arguments for that happening? What are the arguments against? We're going to have a really interesting discussion and debate. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics and insights to help you get the most out of the New Zealand property market. Until next time.